So, okay, all right. Welcome back to the CashInCommon Podcast, everybody. I'm looking at the camera. We're just making a joke about that. We're back. We want to get back and hit the ground running here with respect to new guests. We've got with us today two of my favorite individuals, actually, Voyek Mardula and James Lloyd, and they're from UsProperties, a US-based / Canadian company that encourages Canadians to invest in the US market. They have a very clear system for how to do it. It's a really, really interesting. I personally have been considering doing it myself. We've had lots of conversations about that. It's a great investment. We want them here to tell us a little bit about how the US market is looking, so specifically in the Detroit region. And also, tell us what they think they see with respect to the Canadian market long term, whether it's a good idea or a bad idea to invest in the Canadian market. But first, I think it's good if we start with just sort of an origin story, if you will, with respect to the two of you. Voyek, your history in business. We know that you have some long-term history in business, and how US Properties formed, why it's something you see as valuable in the market today. And, maybe you guys can just give us an overall history of what's going on there with US Properties.
Absolutely. Yeah, thanks for having us on the show. I really appreciate the time. Want to give you a little background on myself, and James will give you a little more background on the company and how we formed. So we've been in existence since 2016. We had started to buy properties for our own portfolio because we found out about the market and the exciting developments that are taking place there. Detroit had just gone through bankruptcy and was recovering from bankruptcy, so there was a massive opportunity to purchase property at a cents on the dollar, and so we went in there just really wanting to establish a portfolio for ourselves, a cash flowing one, and over time, over a course of a year, we had used up all the funds that we had intended on spending, and some of our friends and family started inquiring about what we were doing. Through that process, we really found that there was very little information for Canadians looking to invest in the US market that was centralized, having to do with, how to form your companies, what kind of taxation issues you may face, what type of neighborhoods to buy in, what types of properties to buy in. And so we really started to gather information on how to do that, and what's A to Z for an individual who's Canadian who wanted to purchase a property in the US. What are the steps that they would need to take?
A little bit, right? There's some things there that are just a little bit tricky, right?
Absolutely. It can be. Mostly, there's a lot of conflicting information being delivered from U.S. attorneys that are posted online, and and Canadian ones, and some Canadian ones. A lot of them have incorrect information, and a lot of, in particular, a lot of U.S. advisors, will advise Canadians to form a certain type of company, which is fine if you're a U.S. citizen, but it creates double taxation if you're a Canadian.
Right. Yeah. So let's, before we go into like the details of like, okay, here are things you need to think about. Tell me. So first of all, tell me about your history. How did you stumble on the fact that Detroit was a place to go? Bankruptcy as a thing.
That's when most people are running away, right?
Most people are running away. So you're thinking, okay, I'm not going to run away. How did that happen? Right?
So it was an accident. Actually, it was at a New Year's party. I was spending some time with some old friends, and they had just moved from South Beach to Detroit. He actually went into a real estate educational program, and he was advised by one of the instructors that Detroit was an up and coming place to visit and to invest in. And so he had gone to Detroit and purchased his first few homes on a credit card for about $10,000 at about $5,000 each.
Wow.
And so, houses that would cost, $200,000-$300,000 to construct, maybe more, with the current costs. And so he had told me about this, and I thought, wow, what a great story. You just bought 2 houses on a credit card,
Sure.
like a low balance credit card or low limit credit card. And so we had decided, my wife Pamela and I, we had decided to come and take a look at the market. And by then, my friend had already been living there for 6 months and buying as many properties as he possibly could, because he felt that it was such a massive opportunity. And so Pamela and I went down. We bought a couple of properties, similarly, a little bit more than 5,000, but not that much more. And then we went through the process of having my friend renovate them and having them tenanted, because we really wanted proof of concept, right? I'm sure all the listeners and viewers on this podcast want to see that this works for themselves.
For sure.
So
Pamela's your wife, by the way. If people,
Absolutely,
she's not.
absolutely,
She's here in the room,
absolutely.
but she's not on camera. Okay, so that's interesting. But prior to this, what were you doing? Like, this is obviously wasn't initially the way you built wealth, right? You had other ways that you did that. Maybe you want to give people insight into how you were doing that prior to this.
Absolutely, yeah. So I'd been a business owner since I was 22, so it's 20 plus years now. I started off in hospitality industry. I was at McGill University. I did my BCom there, and before I graduated, a friend of mine and I had opened a nightclub on Saint Laurent Boulevard in Montreal.
Nice.
It was a very hot, central street back then, and came to restaurants and hospitality, and we got very lucky. We had Prince show up at our nightclub.
Oh,
and
nice.
So yeah, it was it's our claim to fame, and then the nightclub really became very popular after that, and stayed very busy for many years. So I started in that industry, and then I got into apparel. I was in manufacturing, in wholesale, retail, warehouse sales. I did pretty much the whole spectrum of apparel. And it wasn't until 2010 that I really bought my first piece of real estate, and became a landlord inadvertently. And the rest is history. And then and it wasn't until 7 years later that we actually got into the Detroit market, or 6 years later that we got into the U.S. market.
Interesting.
And
you did that in Canada. You did that in Montreal, or that was...
No, in Toronto actually. In Toronto, yeah. We had purchased a condo, and we kept it, and we bought another house which had a few more tenants in the basement. And so it was like we were part-time landlords, but still having a career and doing stuff on the side.
Most people, yeah.
Like most people, right? And it wasn't a full-time career path until 2016, where we really discovered the Detroit market, and we thought, wow, what an opportunity here, where you can get both cash flow and appreciation.
Got it. And so now you built this system out for US Properties. What is US Properties? Tell everybody what US Properties is.
Yeah, James, do you want to maybe touch on that?
Yeah, of course. Hello, everybody. My name is James. I'm the Vice President of Sales here at UsProperties.ca. Right, it's a real pleasure to be here today. I think that was a really great description of it's a bit of the history of Voyek's business experience in the early days in Detroit. Right, for us. I think that he gave a really good understanding of what the initial attraction was. I think, like a lot of your listeners, sort of around the 2016, I think Voyek and his wife Pamela were looking for better cash flow. Right, and the opportunity for maybe less expensive acquisition and scalability. At the time, Detroit was really going through one of the great recoveries, right? Really since like the Great Depression, right? Where there was a tremendous bailout by the U.S. federal government, and then the private sector came in, notably by some major U.S. billionaires, and started to really put money where nobody else was, into the downtown core, right? And that sort of stretched out into these residential neighborhoods where we operate today, right? So I think through a lot of courage and business savvy, I think Voyek and Pamela saw a business opportunity to create a turnkey boutique real estate company to help Canadian investors, predominantly Canadian investors anyway, with a turnkey solution, like I said, and to get into the cash flow real estate market in Detroit, Michigan.
And you guys so it's strictly so far just in Detroit?
Well, see, for us, our product is so much more than just Detroit. It's like I said, it's a full turnkey system, and that includes property management, that includes construction, that includes everything that you would need to go from listening to a podcast like this to be set up correctly with a legal advisory network, U.S. banking, business banking, insurance, lending. We have all that at our fingertips, right? And when I speak to potential investors on a weekly basis. There's some people who've been interested potentially going into the U.S. market, but I found it maybe, quite frankly, a little daunting. Like, where would I go? Who's going to help me? Like, where's the good and bad neighborhoods, right? How do I get set up correctly? That seems like a lot for somebody to do individually. So the fact that we're Canadian at our core, right, have this notoriety and reputation, and with some of the premier real estate investor podcast hosts, right, and networks, I think it really strikes a chord. We found a really cool niche where we're helping a lot of Canadians enter the market, with good quality, sound advice from years of hard work. And, I think at this point in our development, our turnkey system is well matured, and we really know the lay of the land.
Yeah.
Right.
I'd like to hear. So tell me, how was the first years of figuring that out? Like, what did you do?
Yeah, what are some of the stuff?
Well, I'll let Voyek talk about that. So initially, Voyek was kind of a one-stop shop with his wife, right?
Okay.
So
And you came on board later.
a little bit later, yeah. So
Okay.
Voyek and I have known each other for, I'm not 100% accurate, but since the late 80s, we're close friends since junior
Your
high.
age there, sir.
That's all right.
fine. That's totally fine.
We work together, in different capacities, predominantly where he runs the business and I help with the sales, right? My passion's always been sales and customer service, so it's always been a good fit. But I guess it would have been 2018 I came on board just to help because, Voyek spends a lot of his time dealing with construction and contractors, acquisition, the back end of the business, where I have a passion for the front end of businesses, right? Customer service, customer acquisition, and really just helping people.
That's key. That's really key.
Yeah, from initial reach out to a little bit more information through guiding them step by step, through our turnkey system to ownership, right? And cash flow. Like you said, it is complicated, but we really do have it down. Like I was saying, we're well matured through our systems. Everything is it's tested so many times over again. It usually starts with reaching out, getting some more information on what we're doing, how we could help. And if there's interest, we'll show you properties. Then, of course, we'll introduce you to people who could help you with the correct entity formation, right? We have that legal advisory network. You can have those conversations with them, get yourself set up.
Yeah. So what's the? Look, if you're someone who's a Canadian who's never done this before,
right?
What do you think is the thing that's going to scare that individual the most, and what solution do you have for it? Do you guys have?
Well, just before I pass it over, there's always concerns with people who are Canadian. It is taxation. I get a lot, especially with people who are a little bit more experienced in real estate investing or who are in relationships, right? And one of the partners will say, it sounds great that you're going to make some good return on investment down there, but are we going to be okay? What's the tax rate in both countries? And so there's things you got to kind of work through that. We have advisors who we can put you in touch with that can then speak that through with a person or a couple, and then you can see from there that this can work, right? That there is a way to do it, and then from there you can look at it just from a straight up investment perspective. Do these numbers make sense for me? What I'm looking for in a return, and we think they will because they're pretty good. That's why we're there. As much as we love Detroit and the Michigan area, we're there for a reason. It's cash flow.
Yeah,
right.
And that's it. That's what I feel like I want to hear that initial sort of like what you were doing to figure out the neighborhoods that made sense, right? Like, I can't even imagine. Like, you come to Toronto, people who come to Toronto have no idea where, this is a rich area. That's not such a nice area. That's the in between mixed area. It's like a lot of hitting the pavement.
Was the
there,
path already blazed for you, or
did you have to do that yourself?
or did you figure it out?
Partially. So the great news was that my friend that introduced us had done some exploration in the 6 or 9 months that he was there prior to us buying, and he had worked with some really good people that he had I'm not sure how he connected with them, but they sort of knew the investor market and certainly knew Detroit well. It was a little bit different back then because everything was so inexpensive that it was like fish in a barrel. You could pick up houses wherever, and they were $5,000, $10,000, $15,000. Now that's changed. But so now you really have to, and so what we've done is we've just monitored neighborhoods for the last 7 years. Initially you're introduced to these neighborhoods and we said, okay, that's good. So we bought in those neighborhoods and we bought for ourselves, but we also sold 500 plus homes to investors who have, and we've been watching their valuations
Right.
and seeing, okay, you know what, this neighborhood is really solid. Let's just focus on this some more. And then, and then we also, we travel there every 2 weeks. And this is where, the time value really kicks in of dealing with us, because we're doing this full time. So we're able to travel there every 1 to 2 weeks, and we're exploring different markets. We just found a whole, 2 different markets in the last 12 months that are spectacular, that are super hot, that we never bought in before, but they're very solid. And so now we're really focusing on those markets. So we discover new ones, but we also monitor the old ones, and we've been quite fortunate that, all the ones like
The older ones are the older ones expensive now?
They've gotten more expensive for sure, and they've gotten
But that's good.
cleaned up a lot more.
Means the
which
people
is-
who
which
own
is
there, the values have gone up.
Yeah.
Right? There's
Positive.
just less inventory now because it's full. Like
Yeah.
And the rents have gone up proportionately, and that's really key. That that we've
That's
seen
a key component, right? Absolutely.
massive, right? Because we can continue to deliver very similar returns that we were able to deliver 5 years ago now,
Yeah.
just by also buying specific properties that we know we can maximize rent in. Looking forward for bigger homes, bigger bedrooms, all these things that
I'm
we
kind
can.
of curious of what a new neighborhood, how that turns you on. Like, what is it that you discovered there that you were like, okay, like this is a new pocket? How did
well,
that
comps
come
for
about?
sure, right?
That
So
we
are there-
cannot tell you.
That's the
Is that
secret.
bad-
That's the
is that
secret.
magic,
That's the secret.
Secret? Okay, I get it.
No, I'm joking around. I mean, look, it's very we follow a certain formula, so we'll find
Yeah.
very hot neighborhoods, and you tend to buy ones that are adjacent to it. Like if the prices have gotten
Okay.
very high there, so you're buying within a radius, with some exceptions,
That makes
because
sense.
there are some pockets that are not great that may be across the street. That this happens in every U.S.
Sure.
city. You have
Yeah.
Fifth Avenue, and then you jump over a couple blocks, and it's not great.
Doesn't take much.
So it doesn't take much, right? So we stay away from certain pockets. That's key, but also look for these adjacent neighborhoods that are radiating out, where there's opportunity, where we know that it's in a year or 2 or 3. This is where the true gains are, and that's where really you want to be jumping in when you're buying real estate.
And that's really that's like the work that you've done. Is like you figured out, okay, this metric, maybe it's, I don't know, Starbucks on the corner or something. You're like, okay, that's an interesting metric, So you figured it out. You guys have your system that you do it. The point is that took a lot of time, I imagine.
Well, that's
right?
testament to Voyek and Pamela. They really do the legwork, right? I mean, they're
Yeah.
not just sitting back here in Toronto. Even at this point in development, I mean, they're in the car driving down there, bi-weekly, boots on the ground,
Mhm.
right? And because of that, a few things happen. First of all, the construction's very tight. It's great. I mean, they really have good seasoned crews in there doing better than ever renovations in a more timely manner. That's one. And then what comes out of that, to continue the conversation we're having, is we start finding some of these areas that maybe potentially are a little bit different than our traditional ones, where we thought maybe a little bit closer to Midtown. Well, we'll start to realize that there's some areas here where you can acquire some larger homes, but when they're renovated, they're worth considerably higher than the normal sort of Detroit pricing, right? And you can get a little bit higher rents as well. And even some of these areas have lower property tax, so it's a real home run, right? And we've come across some of those areas recently. We're really excited about some of the current larger properties that we're selling because they just work so well in today's market, right? It's exciting stuff.
So there are really nice, like we were just talking about before the podcast, right?
Yeah.
There are nice areas
For
in
sure.
Detroit
Yeah.
and I suppose now a lot of these areas, a lot of the areas that weren't nice are not nice,
Yeah.
but there were always expensive areas in Detroit.
Yes,
Right?
for sure. Well, they had a great, industry there, right? So
Right.
some of these homes, particularly like some of the famous areas like Grosse Pointe and places like that, where the CEOs of the automotive industry live. But
Yeah.
more than that, there
Whitney
are.
Houston, I think, used to live there.
Well, a lot of the Motown people as well,
That's
right? Or
right.
Boston Edison, Boston Edison and areas like that, right? There's some big mansions there. It's an interesting place. Like most major American cities, there's a mixture of neighborhoods, right? But we really curated that to find the good ones. And so typically, we're operating in B-class neighborhoods, either Northwest Detroit or on the east side, or sometimes closer to Midtown, right? Where it's super high appreciation, quote unquote, hot pockets, where there's lots of comps, where if we were there today or your listeners were there today in a car, they would like what they see. They'd see rows and rows of brick colonials and bungalows. Yeah, it's fairly
Nice.
well kept. And it's good stuff. That's why a lot of the major American REITs and real estate funds are buying there as well. It's the properties are going up a lot in value and the cash flow.
colonials and bungalows, like it's like the annex or something.
Yeah,
That's like Lower West Village or the East Side, right?
Yeah.
Wow.
Yeah.
And do you think a part of the regeneration is a part of the growth? Like there's a buzz in Detroit, right? Like more people are moving there, and there's jobs flowing there. Can you kind of like touch on that? What you've been seeing? 'Cause
Yeah, like what's
you're there all the
increasing those
time,
rents?
right?
Like what's going on there? Why is the rents increasing there?
Absolutely. So, well, what happened in 2010, even pre-bankruptcy, there's been a couple of a very wealthy businessman, namely Dan Gilbert, who owns 100 companies, including the Cleveland Cavaliers and Rocket Mortgage, which is the biggest private lender in the country. He's a Detroit native, and he in 2010 started buying up towers downtown Detroit. So these massive, beautiful buildings that were constructed in 1930s that house, thousands of employees potentially, and he pick them up for like $10 million, which they're worth $200-300 million now,
right?
Post renovation.
These are like commercial towers,
office towers.
Office
Same
towers,
that you
Canadian
see
place.
downtown Toronto, and what he had done is he had moved the head offices of 100 companies into Detroit, which were spread all over the country, and he had incentivized people to move to Detroit to really create a sustainable economy where people are there spending money and would attract others. And so what followed was, a huge barrage of restaurant openings and boutique hotel openings and massive events that were done in Detroit in order to stimulate the economy. The sports teams were centralized and brought into downtown. The Detroit Pistons were moved into downtown. There's a new stadium that was constructed for the baseball stadium, Detroit Tigers. The Red Wings got moved to a new stadium, which are sharing it now with Detroit Pistons. So there's been a huge volume of infrastructure that was built downtown, renovated, and so what that created is an environment where people started moving from all over the country because the cost of living is so low, right? So you have young people who are in their 20s moving there, and they're able to rent a house for $1,000 a month and yet live on maybe a $70,000, $80,000 or $100,000 salary, which creates a huge amount of disposable income and an excellent, cost of living, and very low cost of living, and and amazing lifestyles are being created. And so word got around, and so now in the last few years, downtown Detroit that was seeing an exodus or a decrease in population has now turned around, and they've noticed increases in population in downtown Detroit, and the population that's moving in has more finances at their disposal. And so the whole city is becoming gentrified. I mean, every time we go there, we go to a new restaurant opening or a new place that is just like, super trendy coffee shops. There's an entire scene there that's incredible. I mean, there's more restaurants opening there than in Toronto right now. Wow. There's more boutique hotels opening in Detroit than in Toronto at the rate. And especially given that, Detroit is a city of under 1 million people, the core, right? Versus, Toronto, the greater Detroit area has 6 million people. So there's a huge amount of population in terms of, in terms of driving rents up, because that's what causes it as well. And then so as the city became gentrified, the rents started to go up, and that radiated all the way out. And so now, when we first started operating there, getting $900 US in rent was a stretch for some of these homes. Some of those rents had doubled now. It's only 7 years later, doubling in rents. It's massive.
Yeah.
So.
Is there so like you think about a city like Toronto, and there was a time in which it was cheap, I think, probably. Right?
Yeah.
Do you remember that time?
I don't. Sorry, I wasn't around. But I just mean there must have been a time.
It was cheap.
That it was cheap. Sure. And so my real question then is you look at Detroit, you're saying, okay, there's certain things happening that are making this city more gentrified. That means that there's got to be a horizon of some kind, or at least there's got to be a timeline when, okay, that's just expensive now, right? And we move on to the next or something.
Well, Midtown's gotten a little bit more expensive recently.
You tell me, is that a potential risk, or is that sort of like the way Detroit is set up? Maybe that's not going to happen, or is it not going to happen for a while?
I think that, there's certain pockets where
Right.
we just don't buy, and,
That's right.
and we actually never did because it was even kind of expensive to begin with. Now it's gotten really expensive. That includes the pure downtown core, or, even this area of Grosse Pointe that we mentioned that was kind of like equivalent to Toronto's Bridle Path. I mean, it doesn't make sense from an investment standpoint, right? Midtown has gotten too expensive. But then again, there's a peripheral area near Midtown called the North End, which we do tons of business in,
Sure.
and that's an area that's, tripled in value in the last 4 years, but it's still increasing at a very fast rate, and the rents have gone up. It's very close to Wayne State University. So that's an example of a pocket. And so we just move to different areas as areas become too expensive, because every investor that comes in has certain notion of what they want to achieve from a return standpoint, right? So if returns are not good in that area, usually the taxes have gone up in the area too. So we just move to another area, right? Where you can achieve the returns, and you can buy, and you can capture some equity. And that's something that we really do offer to a lot of our clients too. We often, we've had clients recently who had purchased properties, for $250,000, and it'd come back with a $292,000 appraisal. For the same property.
That probably
So-
wasn't
so-
happening though
so-
in 2016, 17 when you were first doing this, right?
Well, that particular neighborhood was rough back then,
Yeah.
right? And then all of a sudden, investors got a whiff of it and started really heavily investing there. And then, Jamie Dimon came along, and he invested huge amounts of money on behalf of his company. And it's just, so there's these REITs and larger investment and bankers and private banking that's coming in, and they're buying entire pockets, and that can turn around an entire neighborhood. Right. And then,
Yeah, of
the
course.
flippers come along, and, they're buying for their, for end users. And now the values all of a sudden are way up. Right. And then it's benefits,
opportunity's still
everywhere. 100%.
There's still lots of
100%.
opportunity. There's lots of neighborhoods, right? And I'm not meaning to make it light of it, but like as Voyek said, as neighborhoods, fill up and it starts to become more expensive, usually the one next to it, becomes available.
Yeah.
And a lot of this investment that he's been talking about from guys like Dan Gilbert, he's put, hundreds of millions of dollars, I'd imagine, into these areas like, the blight elimination and the extension of public services like the Q line, which is the major streetcar line that goes up Woodward Avenue, which is like Detroit's Yonge Street. And that's that, there's been some plans to extend that into one of the neighborhoods we really like to invest.
Nice.
It's like the North End, right? So, we really do know Detroit, as you can imagine, and it's not just us and Voyek and Pamela, but we have the team on the ground there, right? And on a daily basis, we're communicating with them to obviously to acquire homes, but we know them and the neighborhoods exceptionally well, right? So we're always acquiring, and it's exciting at the moment because we're just finding these new neighborhoods and these new pockets still.
Did you
That
see
is
any?
exciting.
Yeah, it's super exciting. I wonder whether, just for my own curiosity, did you see any shifts in things from COVID to now? Was there an impact that COVID had there that was different than here, or any idea?
I think COVID had a massive positive impact on real estate
Really?
everywhere.
Yeah.
It was crazy.
It was funny. The
was,
first 2 months, everyone was like, "Oh man, this could be bad," and then all of a sudden, it went the completely opposite direction, right?
complete opposite.
Yeah.
Yeah, I think people became more in love with their homes, and they spent so much
Yeah.
on home renos, and they've turned their homes into offices, and so now it's a dual
Cheap interest
purpose,
rates.
and so cheap interest rates, and so all of that resulted in people really driving values and refinancing, and putting a lot of money into renovation. I mean, Home Depots were sold out of materials. We couldn't
Yeah.
get materials
It's
for a while
insane.
because everybody was taking the government's money and doing renovations on their own homes, and then refinancing them to get more money out. So, so that happened a lot. And we feel that, the trend, Detroit's mayor, Mike Duggan, is super business friendly, as business friendly as you can get. And he's hugely responsible for Detroit's comeback, and his relationships, and he's always, dealing with the state and trying to get the taxes down, and really inviting business and being very open to people buying and developing real estate, and he came out about a year and a half ago, and he said that Detroit is in the third inning. That's where he feels as far as their long-term plan is. It feels
Wow.
that he has 6 innings to go in order to really bring it back to a world-class city that it was in 30s, 40s, 50s, where it was the hub for auto manufacturing in the world, would produce all of world's cars. That's where they came out of Michigan, and all these beautiful properties were constructed during that time. So they're just these spectacular, beautiful brick colonials that you find here that cost $3, $4, $5 million here, and you can pick them up for $150,000 down there, below cost of construction. That's why it's so exciting, because to even fathom that these properties are going to be less in the next 10 years, that's a very difficult bet to make. We're actually betting, and we have a plan to stay in Detroit for the next 10 years, 9.5 actually. Now we made it 6 months ago, but because we feel that there are still 20,000 homes that are abandoned in Detroit. That's how many homes that you can get through, and that's and there's so many of them that need upgrades that can be driven, neighborhoods that are coming together, so that we feel that there's that much more opportunity for that many years for anybody considering. People who think they may have missed the boat, you haven't. You missed the riskiest, the craziest time where things were not 100%, and now they're coming together. But the opportunity from now for the next 10 years is huge.
And these are mostly, are they suburbs of Detroit, or is it sort of like, are you close to the core?
It is Detroit actually proper. It is, well, there's the downtown core. I would say most of the neighborhoods where we're operating are in Detroit, but they're maybe 10 to 15 minutes outside of the downtown core. I think predominantly when we first started, one of the first areas to gentrify was like Northwest Detroit, right? Some of the notable areas like Bagley.
Expensive now.
It is expensive now, right? But just going back to one of the things of COVID that was really fascinating to see, because the U.S. border was closed for a long time. What was it, like a year and a half or a year? Anyway, we couldn't go. It felt that way anyway, right? So when it reopened, I remember when Voyek reopened, Voyek was right back down. And what I was going at is like, initially we did a lot of business in Northwest Detroit, some of the famous neighborhoods over there like Bagley and the University District and places like Martin Park, etc. What happened, was Detroit continued to gentrify like heavily during COVID, and it really started to transition over to the east side, to some areas like Morningside, East English Village and Jefferson Chalmers. And I remember Voyek calling me just saying, he goes, James, like Morningside, it's like Bagley now, right? Like, and so it's kind of like, when you haven't seen one of your nephews in a few years, and you go see him, and he's all big and tall, right? And Detroit has continued to grow, right? And, so it's moving around the neighborhoods. It's going more on the east side. We're having a lot of success over there, lots of comps. Some of the pockets over there are great because they have, high values and low taxes, right? We like them. There's like, Cornerstone Village and Pengree Park, places like that. So it's been amazing to see the transition, and it just keeps growing.
Is there still like a rental assistance programs there that people can tap into as investors, or is that not available anymore? Yeah. Just like I figure like it's gentrifying. Does that mean that these programs are going away?
No, we work a lot with federal rental assistance programs. As a program called Section 8, which we've been working with since we've been there, and a lot of our customers and our clients and our investors continue to use them because it's guaranteed income by the U.S. government. And so once a tenant moves in, you steadily get a deposit every single month from the U.S. government that covers 80 to 100% of their rent. So so it's a really fantastic program because the individual can choose whichever home they wish to live in, and they can choose one of the best neighborhoods in Detroit, and they can actually move in there, and they have a great place for their kids to go to school, and better schools, better education. So it really is set up for people to win and to sort of get themselves from a bad situation into a good one,
So you're still plugged into that world, and you can set an investor up with that.
Yeah, for sure. It makes a lot of sense for an investor going into some of these neighborhoods in Detroit, right? It's just a guaranteed rental program. Like on a monthly basis, the property management teams that we work with will approach the agencies in Detroit for an applicable family with a Section 8 voucher that matches the market rent for the house. So it really isn't going to make much of a difference whether it's a cash tenant or a Section 8. Market rent is market rent. And from there they'll screen them like as if they were a cash tenant. They'll look at to see if they have any past issues of eviction or discrepancies of criminal record. No, the property management team will do that with the agency and the individual, right? So we can place, proper families, in these homes, right? And they our record has proven that they stay long term, and that you can raise the rent on an annual basis through what's called a market rent analysis through our property management teams, and it's a very stable return, right? And that's what people are looking for. These are cash flow properties. I don't think anybody has plans there to go down for a weekend to stay at the house. I mean, in some cases there's some Airbnbs, but these are rental properties, and we're looking for rent coming in every month. And it's just been a blessing. Particularly, let's say like during COVID, where there was issues with moratoriums on eviction, and people were being told misinformation about having to pay or not. We grew as a company. With the new property management, hire more contractors. We started to go on more podcasts. We started to seriously go on television interviews, and it's because our investors are getting their return on investment, right? And that's some of the blessings that came out of just predominantly working with the Section 8 program.
So let's say someone wants to come in, they tell you guys, hey, listen, I love this idea. I want to get 10 properties as soon as I can. I want to kind of do one at a time. I have, so much money. Let's say 100,000 Canadian, or something like that. How would you guys approach them? You obviously want to help them build their dream and build some cash flow. Kind of walk us through what that might look like.
More than 100.
Well, I don't know. I mean,
we need about 300. We actually have a 10 property portfolio right now available for sale, and it's you do need about $350,000 in order to purchase, but it's outstanding. I mean, you can get 10% returns and more than that leverage returns. So, and the properties, we would create a mix of properties usually where, we feel like, okay, there's some of the A-type properties that James had discussed close to Midtown. We have some of those available for sale. We have some smaller bungalows that are just individual single family homes, but they're high yielding. They're, over 10% returns. And then we have some duplexes in really good neighborhoods that we also have available where, those can be converted potentially into a single family home down the road. But they're also, kicking off 2-unit rents. So those returns look really nice as well. Yeah. So if you combine all those together, you end up with a great portfolio. And, James, it's very simple. I mean, James would just guide you through for entity formation, referring you to our attorney. They'll look at your specific situation, what you need to do. They'll form the entities. From there, we just go into contracts, and so we contract the properties, and then we'll go into appraisals. And once the appraisals are completed, the whole file goes into underwriting with one of the lenders, which we can connect you with. You can have a conversation with them, make sure they're a good fit for you,
right?
And then we close, and the entire process can be done in 30 days, provided the document flow is there usually from the client, and they provide everything that they need to provide. We are set up right now that we can get you a 10-unit portfolio in 30 days that you own.
Right. So what's so if I'm a Canadian thinking about getting in the game of investing, why I suppose that's already, the Section 8 is a pretty good reason. It sounds like you got some portfolios that are not crazy expensive. 300 grand is not going to get you very far in the Toronto market.
Yes.
But what is it? What's the real sell for the Canadian to come down to Detroit? What do you guys do that's going to make it simpler for them?
I mean, look, we have investors that wanted to come down and take a look. I'll tell you honestly, a lot of people actually don't want to come down. They've become, ever since COVID, people don't want to go into the marketplace. They don't want.
You were doing that before, right? Tours and that kind of stuff. Is that still you?
We were, and now really what clients are requesting is a video tour of the property, and we're very happy to do that. Take some, some photographs, a video tour, maybe even a video tour of the neighborhood or the immediate block, just so you can take a look. There's so much data on the internet.
Yeah,
and when you have REITs and funds that are purchasing properties, they're not out there driving neighborhoods, right? They're looking at neighborhood data that's available widely to anyone, making sure that the comps are there in the area and that they're getting really good value. That's really all, as far as real estate is concerned, those are the research tools. Those are the metrics that are used to make successful purchases. Yeah. And so that's what our clients do as well, and we take them through the process, and then, the appraisal is the most important document that you're going to get.
You get that pre-closing, right?
So Yeah, so everything, the value's there. You get pictures of the property in the appraisal, you get descriptions of the neighborhood, you get a feel, it's a good sized report that really shows you what you're getting. And so you're comfortable. And then look, if there's a situation, and I can guarantee you that in a portfolio of 10 properties that you're buying, 1 or 2 of them are going to appraise above what we're selling them to. Maybe all 10 will, but at least 1 or 2 will. So you're getting initial equity capture right away, which is incredible. So that's a home run right there.
Yeah.
And then you purchase them. These are mostly tenanted. We may have to add a few extra tenants, or maybe we're tenanting some of them already. And then within 2 to 3 years, as the interest rates, which are expected to decrease in the let's say the next 12 to 18 months, these are predictions by large banks, by everyone. This is what everybody's talking about, 12 to 18 months. So as the rates drop, okay, these investments become even more attractive. So to purchase, the smart money buys in high interest rate environments, because that's when you get deals, right? When the interest rates are at 3%, you're overpaying for everything.
For sure,
right?
you are.
So
prices are really high in that.
Prices are really high, right? Yeah. So you have to really be smart and purchase in these types of environments, because once the rates drop, your cash flow, you're just going to be able to refi 2.5, 3 years down the road. We have companies that, even after 2 years, you're paying very minimal prepayment penalties to get out of your mortgage, and you can refi with the same company at a lower rate. You increase your cash flow by thousands of dollars per month, and you'll be able to, and by then the values would have gone up, so you'll be able to extract most of the equity or most of the money that you had initially invested, and you can do that again.
Right,
and
which is the real. That's the real tip for investors, right?
That's the real tip for investors. Yeah, just you have to refi, and you have to pull equity. That's how you can build a portfolio, because eventually, look, if you're going to invest $300,000 and you don't have another $300,000 sitting somewhere else, what do you do next?
Sure,
that's going to be the portfolio that you're going to own for the next 20, 30 years, right? But but because U.S. lending is so much superior, so it's so superior to Canadian lending, where they really allow you to, it's the asset value that comes into play, not your personal income, which, it's in Canada, they consider personal income as the number one determining factor whether you get a mortgage or not,
100%.
which is nothing to do with the property. Like it's ridiculous.
You got to go bottom of the barrel in Canada to do that, right? Like you got to go like private lenders.
You have to go very expensive,
right? Expensive on the rates, right?
And so what's great about private lenders in the U.S. is that there's the flexibility to borrow as much as you want, but not at ridiculous rates. They're actually very close to the banks, right? They're just a little bit more than the banks. So, and with these cap rates, you can do it over and over and over again. And you can, if people are ambitious and they want to scale and they want to build something substantial that is going to last and going to change generational wealth for their families, U.S. real estate is the way to do it.
I spent a lot of my time, speaking with our current client base and encouraging them any way I can to help, right? With not necessarily as directly with the lending, but pointing them in the right directions with our lenders. And I would just say that too, the lenders are becoming more cooperative with shorter terms, right? I mean, we used to get a lot of 5-year terms on the mortgages, and we're seeing that go down to 3 or 1 even, or none, right? So you can really refinance these properties, and like Wojtek was saying, you're going to see that's where the value lies, right? I mean, everybody wants positive cash flow when they're financed or leveraged, but the real name of the game here is being able to recycle money and pull it from the refi process and scale, right?
So on the average these days, are you seeing 1 year turnarounds on that, or
no, it's a mixture, right? Sometimes we come across properties that we know have some equity there, like substantial equity, especially some of those more expensive ones, because when they're slightly more expensive, when I mean more expensive, I'm talking about $200,000, right? Not $2 million, right? But with that, we're able to more easily capture equity, because it's just the construction's there, the size of the property is there, it's more prone to it. So we've had some investors of late come in there, and they've taken very short terms with the intention to refi maybe within a year, right? But I think most commonly, people will go a little longer than that. Maybe they want to wait for the rates to come down. right?
Usually about 2.5 years. And what a lot of Canadians do also is they'll buy a property, so they'll pull it, like let's say some funds off a line of credit, or they sold a piece of real estate here in Canada, and they'll use those funds in the U.S. So purchase a property in cash, but then refinance it in 6 months, because the U.S. lenders only require a 6-month seasoning period. So in those we've had home run success with those.
For sure.
Because
What's the seasoning period, just so that you can?
Well, they want to see the property stabilized under property management, and they want to. It's all about they call it ownership experience. So they essentially the lenders, it used to be sometimes 90 days, but commonly it's 6 months. They want to see the home owned under the U.S. entity, under management, and stabilizing. For 6 months. 6 months to the day after purchase, you can fund a cash out refi. So commonly, we would start that process with a lender, maybe month 4 after purchase, introduce them, and just start the process so that we're not wasting time. So that 6 months to the day after, it's coming out of underwriting and closing. Right.
6 months.
That's it.
What are your thoughts on that for the finance?
Oh, that's fantastic. No, I mean, we've had some mutual clients. I could vouch for the system is fantastic, and what I've seen with what you guys are doing, really thorough. And the seasoning period in Canada is 12 months easily with big banks. Yeah, for sure. 6 months. It's not impossible, but I mean, it's probably not going to be a big bank that's going to do that for you, right? But it's I could attest to for sure how asset-based lending really works in the States. It's fantastic. We have things called asset-based lending here in Canada, but I don't think the terminology isn't really used the same. It's like what you said, like the only people that are going to really entertain asset-based lending is going to be private lenders at a hell of a rate and fee structure. But, what you see stateside is, institutional lenders looking at property, looking at income, and basically just giving themselves a bit of margin, saying, we'll end up to this because, we can see there's enough return there on a monthly basis that makes sense. And not really, focusing on you as much. I'm sure they're going to want to know a little more about you, but I mean, the approval is really based on the property, right? And that's amazing. And that's why I think is a key to
that's
US
right.
lending,
I mean, they're not delving too deep into your Canadian,
your background there.
Not too much. I mean, obviously they have to. You have to have a credit score that's reasonable, and most importantly, you got to be set up correctly on the U.S. side. You're coming through a pretty trusted referral partner in us. So that helps. But moreover, they're going to want to see that you have some liquidity. So you're going to have the down payment and maybe some reserves on top. Not too much more, but maybe an additional 10 to 15,000. They want to know that there's funds there for the initial stabilization of the property, just in case. But that's it. From there, you have to get the appraisal, and obviously it's got to come in at or above. And then we go through the process commonly, as you know, Roberto.
Yeah. And the great part is that whatever loans you take out there, they don't go on your Canadian credit, despite the fact that they do ask for your credit score. They don't register on your Canadian credit. And we've had investors here who have portfolios here, and they want to be able to expand here, and we say, well, look, this is completely unrelated. You can do whatever you want down there, and it doesn't show up on your Canadian credit. So so it doesn't restrict you.
Interesting. And that's, I mean, have you guys been looking out within the state? So like, let's say Michigan, have you looked broader than just Detroit, or is this sort of like?
We have, first of all, we expanded into the suburbs of Detroit, so those are really great as well.
Okay.
And we actually just sold 2 properties to two investors just right in the suburbs, and they're amazing. There's a lot of industry there, a lot of factories, automaking, like just all kinds of stuff.
And value.
Industry, and a lot of value as well. They're great. We also have an operation in Florida, and so we're able to get properties for investors in Florida. The only thing we found in Florida, look, we did great there. A couple of years ago, we got a whole bunch of properties over to investors, and we got some ourselves and this and that. But the only issue we found is that with these slightly higher interest rates right now, And Florida also got very expensive during COVID. So a combination of that and the interest rates, you're not getting any cash flow. And since most of our investors are looking for cash flow, we've really been showing them Michigan a lot more because there's more opportunity there at the moment. If there's a price adjustment or when the rates come down again, 12, 18 months, we have an amazing team in Florida. We have great construction there. We have great property management. We could get you fantastic properties. But at the moment, it doesn't make sense unless you're doing short-term rentals. And if you're doing that, we can get you short-term rental properties in Florida, no problem.
Have you guys thought of expanding elsewhere, like the Southwest? I mean, that seems to be the new manufacturing hub.
Yeah, you know what? We looked at other markets, and I feel that a lot of them are more established than Detroit, and so that comes with a price tag,
right?
And ultimately, look, if I show you house A and you can make 10% there, or house B that you can make 4%, like look, if you really love that house, fantastic, you can make up for that. But most investors will go for the 10,
right?
Given that it's still a good neighborhood and still a really good house. So why bother with the 4% house, and what we really have in Michigan is a team that we really trust and rely on, and it's constantly growing and evolving. We have access to about 100 people there. Some are full-time employees, some are part-time contractors, some are subcontractors, but we have this great team, so we can really address any situations. And look, it's property, right? So stuff happens with property. You might come up with a maintenance issue, or maybe there's a big windstorm and half of your roof blew up. Who knows? Something may happen, right? We have people that can address that in a timely manner, and most importantly in a cost-effective manner, and create with good value and good quality work. So what that helps with is really having our investors generate or continue to generate good returns, as opposed to having some mishap and overpaying for something and then it affecting their
it's pretty consistently works out the way we need it to for our investors. At this point, in this timeline, at this point in our development, going on 6 years, right? We're in a really good place, for people to approach us. Like Voyek was saying, the team and the systems are, very well matured, right? We really know when you put into the factor, we're going to the same consistently good B-class neighborhoods. The construction's better than ever, I must say. They do a great job with the finishing and getting the homes compliant, going through the inspections at the end, typically through the appraisal process and then the certificate of compliance, et cetera. And you factor in the guaranteed rental program.
It would make sense.
It's a very stable investment. That's why a lot of these homes are attractive. Like I said this once before in the podcast today, to these investment funds, because the single family home market consistently is very stable. When you put in the factor, like I said, the guaranteed rental program, it just produces month after month.
Interesting. So on the construction side, are you seeing sort of like, this is just sort of like, I'm going back to COVID a little bit, but a lot of people working from home? I'm wondering if sort of tenants are doing that, whether you're sort of like, okay, from a construction perspective, we need to have a home office. That's something that needs to be more available. Because I think that Canadians are expecting that would be the case. So I'm wondering if you're seeing that.
We are certainly. I mean, there's a certain amount of population that never went back to the office, right? There's certain professions and certain types of people that are more
changed,
efficient,
right? Everywhere,
and are more productive working out of home. And so those people had remained behind, and so we try and create as many bedrooms as we can in a home, or they're already there. And some of these are smaller bungalows, so they wouldn't have necessarily an office space, but they might have an extra bedroom that could be used as an office. So we are seeing that trend continuing.
So single family bungalows mostly are a big part of it.
Yes, and some colonials that are a little bit bigger, they might go to 4 or 5 bedrooms as opposed to the standard 3 in that bungalow. But most importantly, the trend in the U.S. market is that there's a shortage of single family homes, like right across the board. And they're not keeping up with demand. Like there's certain areas where they just they whatever they can build and construct gets pre-sold even before they start breaking ground, and that continues throughout the country. Like there's just not enough single family homes. So if we can,
interesting. Have you guys thought about going that route where you start to contribute to that problem, or facilitate or solve that problem by building homes?
Yeah, we have looked into new construction. It's right now, what I find about a market like Detroit is that we're actually able to get these homes below cost of construction, and they're already built. Right? So it's a little hard to. Like, it's just
makes sense. So you're not you're not picking up a vacant lot That's like, it's probably going to be more to build that.
We
property out.
did some pretty I guess elaborate restorations in my earlier years there.
Okay.
And while the homes eventually turned out very beautiful and did have the equity, it was just a massive resource suck for construction.
Sure.
And financially, it just took a lot of time, right? Where I think more commonly now we're looking for homes that are not completely vacant, right? That could be lived in, but are typically quite dated. And that's like the ideal mix, like where we can do good quality renovation, demo the kitchens and the bathroom, restore the flooring, look at the roof, and replacing the windows to vinyl windows, and obviously the HVAC and electrical, right? And that can produce a very high grade rental property that is both cosmetically very attractive and it appraises well and it's durable, right? That's the niche, really. I think where we could, for two reasons: for timelines and volume.
And just in terms of numbers there for like an investor. So you guys have already done that. You would have upgraded the property, and then that's what you're marketing.
That's right. We're selling fully turnkey.
You're going
fully turnkey property.
So of course, lots of benefit to that. There's some downside to it, but of course, like lots of benefit to that, especially if you don't want to do too much work yourself.
Well, a lot of people I talk to, that's what they're looking for, right? I mean, it is a foreign market. You're not there. Right, it is remote investing.
Big headache.
Right?
I mean, anyone that's ever done a renovation.
I mean, if you think about the product
own
that we're
home.
Here locally, it's right? Like, so imagine across the border. So, you really, we've really worked really hard to establish the trust, trustworthy people, and working with, people that deliver stuff on time and that are good quality and that are with us long term. And these people have been with us for years, and so we continue to feed them and their families, and they're continuing to help us and our investors. So it's very it's been and we continue to build that network. I mean, we just hired a few new people like 2 weeks ago that are doing some good quality work, and we've given them a whole bunch of work to kind of get through. And that changes sometimes too, and some good contractors kind of fall off, and
that's just part of the game.
It's part of the game, and it's been it's been a labor shortage during COVID, so that was challenging. Like nobody was working, so everything just took longer, but it all gets done, right? And ultimately, as an investor, it's like you're only putting up 3% of the value of the home as a deposit, right? So it takes me a year to deliver your home, which it never does. It takes us like 1 to 2 months. But if it took me a year, and this house now increased by
for sure
20%,
you're making money.
You're only put up 3,000, and you made an extra 20-30. That's a fantastic investment, So from it's a very low risk from an investor standpoint. Right. We end up carrying it. We end up absorbing those extra costs when there's delays, and so because we already have a contract with you as the buyer that it's going to be sold at a price X. And sometimes, during COVID, it took us a few months to deliver it. Maybe it was 6 months later, we were delivering your home. And the value of that home had gone up significantly. And that's why you get the equity capture. So for the wait, it's a bonus for the wait. So, it's been, but now it's really clicking. So it's really good. It's moving.
Have you guys been to the downtown core now is because the Toronto market, the downtown core was super hit by that. Like it was vacant, and in fact now I still see like the commercial market has been impacted quite substantially downtown.
Sure.
I mean, there's some reconfiguration going on downtown there. I'm wondering, like, is that also happening in Detroit? Is there some reconfiguring going on in the downtown core there? And what do you guys see there as like long term?
So it hasn't. It's funny. There certainly isn't as much office space in downtown Detroit as there's in Toronto, and it is at this moment it is still in the high 90s occupancy.
Oh, really?
Okay.
Wow.
Yes. And we haven't seen it to the same degree as you would see it in Toronto or even in Manhattan. In Manhattan, so many businesses around there went out of business because it's ridiculous rent, and they didn't have the traffic, right? And you still have a high vacancy there, and a lot of people working out of home, and just some companies have just cut back and weren't able to get the tenants back in. Haven't really seen it in Detroit. It wasn't, for some reason, it wasn't affected to the same degree. And
I wonder why that is. Any idea?
It's a good question. But when we go there, I mean, I see like the core, the expansion has continued, and I wasn't there for a year, as James mentioned, with that grown nephew situation. But I was looking around, and we saw new places that have opened, new restaurants, more growth, more hotels. And I think it's, it's such a widely visited city too. There's so many events. There seems to be events going on there from like April 1st until like November 1st. Every weekend there's something going on.
That's a good indicator.
It's huge, right? And there's conventions happening during the week. Then you have the sports teams. They have people coming in. There's bachelor parties. There's 3 casinos or 4 casinos.
I mean, universities there too. No?
There are.
Yeah, it's a huge university, Wayne State. So there's 40,000 alumni that come there.
Isn't
every
Detroit
year,
Mercy there?
Detroit Mercy's there too. Yeah, that's actually very close to. That's actually right in one of the neighborhoods in Northwest Detroit. Yeah, so they have like 10,000 students, and so we do have some students renting, especially in the Wayne State University. That's great because
those are usually good tenants, actually. Right?
I think too, like it's got to do with
pay the rent.
Yeah, exactly.
It's got to do with the timing of this massive investment that we've been talking about. That's been going into the city, right? I mean, like it really wasn't that long ago that these billions of dollars started pouring into downtown Detroit, right? And it's just sort of. I mean, I tell you, when if your listeners want to invest with us and they want to come down and see it, it's going to really blow your mind. I remember when I first went with you, probably in 2018, and I first got down there and I saw the new sports arenas and just how busy and clean it was, and the restaurants and some of the boutique hotels you took me to and these neighborhoods. It's really a great story of resurgence. That's gone in there, and it's really coming back. I think just further than that investment, there's just been a massive influx too of like the tech sector has gone in there, and when you're downtown, you can really see the presence of people like Google and Microsoft and Snapchat. It's become sort of the Silicon Valley of the Northeast. They moved in, so there's been a movement of different industry, and the young people have come in, and it's still happening today. It's still hopping place.
That's cool. You want all those kids staying there.
Yeah.
Right? Like
That's right.
University kids.
Yeah, young blood's always good for a city, right? Absolutely.
That's right. And we know what's exciting too. I just wanted to add to that real quick. The automotive industry, as we all know, is becoming. There's a conversion going on, right, from combustible to to electric, and what Detroit is really been working on since we've been there is a conversion of these standard plants and factories.
Right.
They have the labor force there. They have the plants to produce cars for most of the world if needed. And
I've seen the Packard plant though. That was
yeah, that was a little beat up for sure.
Yeah, I don't know what it's like now. But I hear it's changing. Like I hear like even the Packard plant has been certain components of it have been.
They're reviving it and rebuilding it into something different.
Cool.
There are other plants that have been converted into electric vehicles, and so they've been purchased and there's been a full conversion going on, and so they're producing 80% of U.S. automobiles right now are trucks that are being sold, and so
those are still selling crazy.
F-150s and Escalades and Navigators and all that stuff. So all of those are doing extremely well, better than ever actually. And now they're being converted into electric versions of those in the next few years because we only have I think it's
already
like 25 years
now.
left of oil left. I think
sure, something like
2047. They said
something they're saying about
no more
oil
at the current rate.
Yeah,
there's going to be no more oil. So you'd think within 10 years people would really get to stop buying these types of vehicles and fully convert.
I mean, if that becomes the hub for electric vehicles,
they converted the downtown, the old original rail station, into a research center for hybrid technology. It's pretty cool. You should come over the bridge there.
Yeah,
Ford's done that. And it's already started, guys. If you see like the new Mustangs that come out, just yesterday I was watching some Sunday football and they were showing the brand new electric Escalades. Right? Wow. Unbelievable things. I could see Voyek having one of those. But really beautiful cars, right? And a lot of these, it's the last year of the V8s for the muscle cars. They're finished. It's just old technology. It's all going 4-cylinder hybrid now.
It's kind of crazy.
And Detroit is really at the forefront of this development.
Interesting. Yeah. Like so, there's a lot. I know you don't like this, but it's a lot of value prop there. You know what I mean?
A lot of value proposition.
So a lot of value that comes.
I think that's conversation to have though, because I mean, listen, Detroit hasn't had the best reputation.
It's got a terrible reputation, right? Like it used to be anyway. Now,
so to actually hear what's happening on a real level, not like whatever in some movie or wherever else you heard it in a song or something.
Sugarman. Searching for Sugarman. That's what I think. I'm like, oh man. But Detroit in the 70s was a rough place.
8 Mile, right?
It was
very 8 Mile for a really long time. And look, there's still elements of that, absolutely.
Yeah.
But if you go to 8
But
Mile.
that's any city, right?
Any
Elements of
city,
that.
any
Elements of that.
U.S. city, you know, there's going to be bad pockets wherever you go, and you know, but I really tell people, look, just go down there and see it. Go downtown, like spend some time touring downtown. Go shopping. Just really, you can feel the development. You can see it everywhere. Everywhere we go, there's cranes. There's this. There's that. There's just and there's new businesses opening everywhere. There's new streets. There's bike lanes being put in areas where you'd be like, wow, this neighborhood's a bike lane. You know, it's just, you know, but it does, and it's really, it's incredible what they're doing, and they're really not just focusing on one area and sort of forgetting the rest. They're really, the effort is being made into all the neighborhoods. Some at faster pace than others, but you see neighborhoods where we wouldn't buy before, and we would drive by there and like, wow, we're like, we got to get some stuff here. Because this is incredible what they've done, you know. And once people see progress, they also start participating in it by cutting their lawns and maintaining their homes better.
Sure,
And
that's like what's the broken window theory, which is like, you know,
That's right.
the more like if you clean up graffiti, it's likely to just better the neighborhood long term, right?
That's right. There's so much pressure from the community and from the block
Sure.
to, you know, hey, like this guy, you better clean up your yard because we're trying to clean up our act here and bring the values up because it benefits everyone, right?
Right,
and so
absolutely.
people are very vocal about maintaining their blocks, and there's a real sense of community, and people see what's going on, and a lot of people made a lot of money over the last, you know, several years with their properties appreciating, and so they want to continue
keep
right?
that
So
going, yeah.
you know,
So if someone wants to invest in one house, they want to just kind of get their feet wet. Like, how much capital do they really need? And
Well, I
approach
mean,
it?
look, there's two means,
Not
right?
much.
It's, you know, relatively, that's right. What Voyek's saying, you know, we do a lot of business of people coming in still and buying on their first property outright. There's the advantage to that is you can do a cash out within 6 months and pull the full equity and hopefully some appreciation out of the house and scale. So that's exciting when we can see an investors recycle an initial investment brought down from Canada over and over again and build onto multiple properties. And we have a lot of success in those types of deals with the appraisals and equity, the equity that comes out of the construction and the neighbor quality. You know, and that in today's market, you know, we're selling homes anywhere between 100 to 250,000. Okay.
And they can't get anything in Canada
What's
unless you're really far
Can
away.
they leverage that first one?
Of
Yeah,
course.
can they leverage
So that's what I was
They
going to
can.
say. So what's
They
sort
can.
of transcribed in the last several years is it's become more accessible to get a mortgage right out of the gate. Right. You're going to want to still do it the same way by approaching us and get set up correctly through our network, because you're going to need to get some entities formed in a U.S. business bank account. And then the only difference is in the acquisition is that you're not going to have to pay the full payment. We'll introduce you to one of our lending partners, and currently it's 30% down. And you know, it's like Voyek and we've been talking about today. It's asset-based lending, so they're just going to want to see you set up correctly. They're going to want to see the down payment. They're going to want to see some liquidity, and from there, we have a lot of experience in making the deals close on time.
Cool.
Yeah.
Well, listen, guys, it's been a pleasure.
Yes.
We're almost at the hour mark here. I just wanted to ask you, what's the like? Is there any information, any tips you want to leave with our listeners here for why they should get involved or how they can get involved?
Yeah.
Well, we can
I
talk
think
about
that-
why. We can talk about how, but let's just say why. Why do you think they should?
Yeah, I think that, you know, look, there's a massive opportunity that remains in the U.S. market, specifically in Detroit and Michigan, where you have a lot of undervalued properties still that have the possibilities of doubling and tripling in the next 10 to 15 years. So if you're serious about, you know, really having cash flow while you appreciate, it's very difficult to find another market that's, you know, that's good, that could produce those types of returns. And there's so much upside potential that, you know, with 6 million people in the area, and now the population growing and increasing, and the rate of development that's happening there, it's very difficult to find another market that's doing just that and ticks off all the boxes. Right, you know. And so if you're, you know, I think a lot of real estate investors, they invest into something and they see that there's long-term potential, long-term growth, and, you know, maybe in 10, 15, 20, 30 years, I'm going to get something out of this once the mortgage is paid off. And that's kind of the Toronto investment mentality, right? Just pay the bills and like just survive until you sell the property, right? But if you're in a position where you may be in your 30s and 40s or 20s and you really need the cash flow, you have kids, you want to, you know, and you want to build something more substantial, maybe you don't have $1 million right now, maybe you only have 50,000. We can really start with 50,000, and if you follow our system, you can turn that 50,000 into $1 million or $2 million portfolio within 10 to 15 years, and we can show you the steps. This is not something that that's fabricated or made up or a theory. I can show you actual results of how we're able to accomplish that, and that's really what's most powerful. I think that it really that's what's possible in U.S. real estate. It really is very difficult to accomplish here because you can't get anything for $50,000. Right. You really can't. Yeah. And then you can't refinance it later. That's a problem number 2. So you can't really grow unless you have a steady source of income that you can keep adding and building your portfolio that way, and it will appreciate over time. But you can't do it with just one investment. Right. And it's possible there.
That's so amazing. How can people get involved? Do you want to just maybe give
I would just to follow on what Voyek has just said, it's just encourage everyone to reach out and start the conversation. We have a website, UsProperties.ca. If you look through that, you'll get some great background information and more details to further what we've talked about today. And there's a submission link where you can reach out to us with a bit of detail. And I got to tell you that I respond to every one of them. Or you can reach out directly to me at James Lloyd, LLOYD, at UsProperties.ca. And we'll just start. We'll have a conversation. I'll go over, listen to what you're looking for, go over what we can offer, and just start, with the conversation. And, we're here to help in any way we can. So just reach out.
Nice. Mm-hmm. Thanks guys so much for coming on. It's been a pleasure.
Thank you very much for having us.
And I'm sure everybody's gonna.
It was good connecting with you guys. For sure.
It's great to connect with you guys. I think it's gonna bring a lot of value to a lot of people. So appreciate that.
Thank you for having us.
Thank you very much.
Thanks, guys.